Welcome, guys. It is Sunday night, July 13th, in preparation for the markets for Monday, July 14th. We will get into our chart analysis here in just a moment. We're in the process of going through the Mark Weinstein's interview on the Market Wizards, interview with top traders by Jack Schwager. Continue on this. The last time we read through this, we saw that he entered in a 3-month competition, turned $100,000 into $900,000. And actually, later in the story here, we find out that that was done with no losing trades during that 3-month period. Not one losing trade. Pretty phenomenal. Schwager asked him, says, and by the way, that 100,000 into 900,000 parlay was after he had lost what was it, 600,000 in the soybeans trade, I think it was. But anyway, so Schwager says, "Do you remember your first soybean trade after the debacle in 1970?" Yes, it was soybeans. Mark Weinstein says, "For a long time, I avoided soybeans. But as I began to find myself trading the commodity market effortlessly, I knew deep down that I would eventually get back the money I lost in soybeans. I never forgot about it." Schwager says, "It looks like you were looking for revenge." Said, "Yes, exactly. Every time I looked at a commodity chart book, my eyes would edge over the soybean chart. Then I would quickly flip the page. I watched the market peripherally for years before doing anything. When the soybeans went down to 475, I knew that they were near a low, but I did not want to buy them until I was sure that I could not lose on the trade. I was like the Sicilian whose wife had been murdered 10 years earlier, waiting for the perfect moment for revenge. When my technical analysis convinced me that the market had bottomed for real, I jumped in on the long side." Schwager asked, "Where did you buy the beans?" He said, "Around 618. Um, this was shortly before the 1988 drought caused prices to skyrocket." Schwager asked, "Where did you get out?" He said, "I got out of some of them at 7.25, and the rest of it at 992. The high of the move was 1046. Schwager asked, "How much do you make on that trade?" Mark Weinstein says, "Let's just say I made my money back in spades." Schwager says, "The way you talk about it, it sounds like that trade was a great relief for you." "Yes, it was a total catharsis. I realized that there was a reason why I had lost money in the first place." "What was the reason?" asked Schwager. "Because I was inexperienced. I do not believe anyone ever gets wiped out of the market because of bad luck. There is always some other reason for it. Either you were off, off when you did the trade, or you did not have the experience. There is always a mistake involved." All right, so skip on down here. This is Swigert talking. He said, "Weinstein, let me make sure I didn't have anything else marked there. Yeah. Weinstein uses his own values, which he frequently adjusts for changing market conditions. He combines the intensive real-time analysis with comprehensive chart analysis, incorporating a variety of methods, including cycles, Fibonacci Dustin retracements, Elliott wave analysis. Finally, add to this one last essential ingredient, the uncanny sense of market timing. Only when nearly everything lines up right and he feels the timing is virtually perfect does he put on a trade. He passes up many trades that he believes have a high probability of working, but for which he lacks the same degree of near absolute confidence. Because of the combination of a lifetime devotion of studying the markets, intensive real-time analysis, innate market sense, and incredibly rigorous trade selection, virtually all of Weinstein's trades are at least marginally profitable at some point within 20 minutes of the entry. That is all Weinstein needs to assure a break-even or better result. It helps to understand that Weinstein usually plays for quick profits and covers his trades within hours or even minutes." Schwager asks him, says, "How do you explain your ability to win such a high percentage of the time?" He says, "Because I have a real fear of the markets. I have found that the greatest traders are the ones who are the most afraid of the markets. My fear of the market has forced me to hone my timing with great precision. When I am trading poorly, it is like a pool player running rack. I'm sorry, not poorly. Sorry. When I am trading properly, it is like a pool player running racks. If my gut feel of the market condition is not right, then I don't trade. My timing is a combination of experiences and my nervous system. If my nervous system tells me to get out of the position, it is because the market action triggers something in my knowledge and experience that I have seen before. I also don't lose much on my trades because I wait for the exact right moment. Most people will not wait for the environment to tip itself off. They will walk into the forest when it is still dark, while I wait until it gets light. Although the cheetah is the fastest animal in the world and can catch any animal on the plains, it will wait until it is absolutely sure that it can catch its prey. It may hide in the bush for a week, waiting for just the right moment. It will wait for a baby antelope, and not just any baby antelope, but preferably one that is also sick or lame. Only then, when there is no chance that it could lose its prey, does it attack. That, to me, is the epitome of professional trading. Also, when I trade at home, I often watch the sparrows in my garden. When I feed them bread, they take just a little piece of at a time and fly away. They keep on flying back and forth, taking small bits of bread. They may have to make 100 stabs at the piece of bread to get what the pigeon gets at one time, but that is why a pigeon is a pigeon. You will never be able to shoot a sparrow. It is just too fast. That is the way I day trade. For example, there are times during the day when I am sure that the S&P is going up, but I don't try and pick the bottom, and I am out before it tops. I just take the mid-range where the momentum is greatest. That, to me, is trading like a sparrow eats. Am I paraphrasing you correctly? Asked Swagger. The cheetah is your analogy for position trading, and the sparrow is your analogy for day trading. The common denominator is that both of them wait for a can't lose circumstance. Exactly. Let's go ahead and jump into the homework here. I'm going to mark this here. So we'll come back to Weinstein tomorrow night. Let's jump into the market analysis here. So this is the SPY on it. Nope, that's the ES. Let's turn to the SPY. So the SPY on a daily basis here. Wanted to take a look at this. So we had the 3-bar top and bottom. We had a new all-time high put in on Friday. We backed off that a little bit. No, I'm sorry, that was Thursday. Thursday new all-time high. Friday we backed off that a little bit. We did have a Keltner channel reversal here where we closed below this candle. This is the Keltner channel. Close outside of the upper Keltner channel. And then this set up the reversal candle here when we closed below that. We did peak back up here, kind of sneak back up. If we come back down or when we come back down and this Keltner channel plays out, we have the 20 period moving average. As I'd mentioned, it's kind of making its way up to the 61 or 613.23, which if you recall, that was those prior highs that we made back in what was that? February of 2025. So there's a good probability that at some point in the next couple of weeks here that we can make our move back down to this 20 period moving average, retest those highs, see if they hold. However, we did break out the upside of that Keltner channel, or I'm sorry, that 3-bar. We did break out the upside of that 3-bar. However, we did not close above that. Right now, this pocket right here that I marked off of this blue, this little V here created this pocket. As of right now, as of Friday's close, that pocket has held, and we have that all-time high in. So I'm going to be aware of that and conscious of that. Was that a failed breakout or not? Still to be determined. The Keltner channel may still be in play for further downside, I said. Also, I wanted to jump over to the 65,000 tick chart. 65,000 tick chart. So this is that, these were those two boxes that measured move. We moved up to the top of the measured move. I think that measured move did play out. We do have a lot of price overlap here on the 65,000 tick chart, kind of between this 62, what is that, 27 up to 68. Like I said, as of Friday, we did hold that pocket. So far right now, as the Globex session, as Asia opened, we've kind of come down a little bit lower. Well, that's for now, we're doing a little bounce there, but that pocket that held on Friday, we've now breached down below it, but we've not taken out these lows yet. So it's still, still could get a little bit of upside, a little bit of play around here before we dump off. Let's see. Okay, so the LBR on the 65,000 tick, good Lord, Greg, come on. The LBR on the 65,000 tick, you see that we were just bullish here. Do not short this. We started breaking down here. Finally, this started in this area, it started opening up to say, hey, we can start looking for shorts again. We went positive again. Now we went negative again on Friday. So again, this does open us up to taking some shorting opportunities or trying those now. I wanted to jump over to the candle on the daily. Let's go to the ES now. You see the candle on the daily of the ES looks a little different. We closed down on that, whereas on the SPY, we were closed up. Yeah, so SPY, we actually closed green, whereas on the ES, oh, come on. We closed down red. So we're gonna watch this 5 SMA play. This close down below this 5 SMA play did play out. We for a close back above it. That's what led to the follow through the next day. This little peak above, and then we failed. So we'll see what happens there. The LBR on the daily on this as well as the SPY. We want to be conscious of this because this daily we have not broken down below on this slow line yet. So we are still staying positive on both the ES and the SPY on that daily basis. So we want to be conscious of that. Even though some of the other time frames, the 65,000 tick chart, the it's 25 sorry, 65,000 tick chart and the 60-minute tick chart and 240-minute tick chart and things like that are starting to show different. But the daily, we want to be conscious of that on the daily. Let's take a glance at the gap chart. So the gap chart as of right now, we're trading somewhere around the 64 zone, 65 zone on the gap. So let's turn that to a 60-minute quick. That way we can kind of see some of those prior gaps down there. So here, if we start pushing back down here, as long as we hold this prior low, we can get some bounce around here. So be cautious as we approach this low. It may or it may not just flush right through that. So we want to be cautious depending on where we're opening tomorrow. That let's say we open and we're getting short. Be aware of this prior low here around the 62.50, 62.45 zone, 45 to 50 zone. Matter of fact, I'm going to make a note on that. That lows, to look for any kind of a move there. Could see a little bit of a bounce, or if we slice through that, then it's game on. Let's go short, to push this thing down. All right, so that's the dot D chart, the gap chart. Wanted to jump over to the internals. Not much to look at here, really. The VIX did play out on Friday, that move up. So I want to be conscious that if the VIX is back below this 1570, we want to be bullish minded. So if the VIX, for some reason, we open up and we're below this 1570 on the VIX, we want to be aware of that, guys, that VIX is pushing down, which could mean bullish for the markets. Conversely, if we move up, we got a lot of room to move up off these lows, 1570 up to 1870 before we get entirely bearish based on a 3-point move. But we'll just keep an eye on that stuff tomorrow. All right. Thanks, guys. Let's have a good trading day tomorrow, Monday. Happy trading, and we'll follow up soon.